So in this video, what we're going to be talking about is interest and dividends. This is going on our Schedule B. So if you have interest and dividends, there's a good chance that you're going to be using the Schedule B. I will say all interest and dividends are going to be taxable, but not all of them are going to appear on Schedule B. It depends. There's certain thresholds that you have to meet to have the Schedule B. Even if you don't have to do the Schedule B, you're still going to have to report your income from your dividends or from your interest on your 1040. So it's still going to be there. But what usually happens with the 1040 is we're looking at our interest in our dividend income. And then what we do is we take the income, those amounts, and we bring them over to the 1040. So we initially do the calculations on Schedule B before we come over to the 1040. Now, for the purposes of this video, what I'm going to do is I'm going to clear up some key areas of confusion. So I'm going to show you a table that has different types of income, and I'm going to show you which ones are appearing, whether they're ordinary dividends or qualified dividends or interest, which ones are going to appear on our Schedule B, and then I'll show you different types of possible taxable stuff, such as our capital gains, and I'll show you where those actually appear, because you should not be putting those on Schedule B. So that's the process that we'll start out with, and then what I'll do is I'll distinguish between qualified and ordinary dividends. And then finally, what I'm going to do is I'm going to go through and I'm going to talk about common mistakes and forms that you should be on the lookout for as you're starting to prepare for this tax season. So let's go ahead and let's start looking at what type of items are going to appear on our Schedule B and which ones should not, and instead where those other types of income actually do appear. All right, well, let's take a look at this. Let's see if we know where what appears on our Schedule B and what is appearing on a different schedule or form. So there's three things that are appearing on our Schedule B that we need to know right now. We're going to have our taxable interest, our qualified dividends, and our ordinary dividends. So when we look at something like taxable interest, that's including things like any interest that you have from your bank account. So maybe it pays very, very small and you get 14 cents, right? Well, those are the types of things that could be included on it. But some people are going to have larger amounts with that. You could have CDs, that's going to be included in it, corporate bonds, treasury interest, any of those things are going to be taxable on it. Now, when you're looking at the taxable interest, it's generally ordinary. So that's where we're going to be taxed at it. Then what you're looking at are your dividends. You have two different types of dividends. And in the next section here, I'm going to distinguish between our ordinary and our qualified dividends. But when we're looking at an ordinary dividend, you're looking at things like stocks, mutual funds, those types of things. And you know what? It doesn't even matter if we're reinvesting our dividends or we don't withdraw them. It doesn't matter what we do with them. They're still going to be taxed, right? Now, if we're in a Roth IRA or something like that, that's a little bit different because we can't take that money out and they can pay the dividends. And if we're not withdrawing it, we're not taxed on that. Okay, I'm not talking about those types of retirement accounts. All right, and then we have a qualified dividend. So they're generally held for a longer period of time. You're going to have to be a qualifying dividend. It has to be investments inside a U.S. or an international company that's traded on a U.S. market. So that'll help us become a qualified dividend. We love qualified dividends because if we're an ordinary dividend, we're taxed at our ordinary tax rates. But if we're a qualified dividend, we're going to be taxed at favorable tax rates, which will be 0, 15, or 20% based upon what our income is. So things that don't appear on our Schedule B, that sometimes people think they are, but if you're looking at the Schedule B, don't put anything like your capital gains. A lot of times people get confused between dividends and capital gains and they want to put the capital gains there. Nope, that's not where it goes. Go Schedule D for capital gains. Rent or pass-through income. In our previous video, we talked about Schedule E. That's where that one's going to appear. Business income, Schedule C. Gambling winnings, Schedule 1. We did a video on Schedule 1 already. Tax-free municipal bond interest, Form 1040, and our retirement distributions, Form 1040 as well. So those all appear in different areas. Now, we will be doing videos on most of those. So, as we go through the tax season, expect to see some videos. So if you do have some capital gains, I'll get a video out there for your Schedule D. I'm trying to do this in a orderly fashion, so I'm going to try to get to some of the 1040 lines, so that way if you're working on your 1040, you have it, especially as these things are coming from different schedules onto your 1040. So I'm trying to make it an organized approach, so if you're just going through the video in the playlist, you can keep up with those types of things. So here's what we're going to go do next. we're going to go look to see what the difference is between an ordinary dividend and a qualified dividend. So that's our next step on understanding our Schedule B. So let's go over there and do that right now. So let's go ahead and take a look at what distinguishes us between an ordinary dividend and a qualified dividend. Now, an ordinary dividend, we'll start there because that's our default. We treat it as though it's going to be an ordinary dividend initially until we can see otherwise. So an ordinary dividend is taxed at our ordinary income tax rate, which can be as high as 37% depending on what our tax rate is, right? That's pretty significant. So that's our default. Now, in certain situations, we can become a qualified dividend. We can have a qualified dividend. And a qualified dividend is favorable because it's going to be taxed at our capital gains rate, 0, 15, or 20%. So if we're in a 37% tax bracket and we have a qualified dividend, now we're being taxed at 20%. Hey, that's pretty fantastic, is when considering we would have been at 37% if we weren't a qualified dividend. So what makes it a qualified dividend? Well, there's a few things. First off, there's a holding period requirement. So you have to have held the stock for at least 60 days within a 121-day period. So it's 60 days within a period that starts from the ex-dividend date, 60 days before, and 60 days after. So within a 121-day period, you're looking at holding it for 60 days. And then what else you have to do is it has to either be in a U.S. company. So the dividend paying company is going to be a U.S. company, or they're going to be an international company that is traded on a U.S. exchange, or it's an international company that is incorporated in a country in which the U.S. has a double tax treaty with. If it meets those requirements, then we can be a qualified dividend, and now we're getting favorable tax rates. All right, so let's go to the next thing. We have two more parts. Let's go ahead and talk about the forms you should be looking for, and then we'll conclude by talking about some of the common misconceptions when we're dealing with dividends and interest income specifically. So as we're collecting our tax forms and putting them in our piles and everything, 1099s, right? If we're looking at Schedule B, we're going to need our 1099s, whether it's the interest or dividends, we need the 1099. Like I said in the previous video, 1099s are always going to be maintained. We need to make sure we're keeping those 1099s because they're going to appear in different areas. The other thing is if you have a brokerage year into the statement, keep that as well. Those are all going to help you as you're doing your taxes here and preparing that Schedule B. So let's go ahead and look at one more thing. Let's look at common mistakes or misconceptions when we're dealing with Schedule B. All right, so here's just a few things I want to clarify that you may run into when you're trying to do your Schedule B, or common questions that are asked. So the first one is, I didn't make enough, right? It's just a very small amount. Hey, that doesn't matter. Maybe you're not doing the Schedule B, but it's still going to have to be taxed, right? So there's no minimum amount. You're still going to have to go ahead and report it and pay the taxes on it. Kind of a pain, but it's a requirement, so we need to make sure we're doing that. I didn't withdraw it. It doesn't matter, right? You can leave your dividends in there. You could even reinvest them. You can do all those things. It's still going to be taxable to you, unless it's in a retirement account, and those are a little bit different. No tax was withheld. That doesn't matter either. That's something that you still have to go ahead and that you're still going to have to pay your taxes on it. Again, I said reinvested. Even if you're reinvesting your dividends, it's still going to be taxable. That's a place that trips up a lot of investors, especially new investors who've invested the money and they know from like Roth IRAs and stuff, hey, I'm not paying taxes on all this stuff, so I don't have to worry about dividends and everything like that. Well, it's different when you have an account outside of a retirement account. So you do have to pay that even if you're just reinvesting things, right? So if it's on automatic reinvestment, one of those drip types of things, right? You know what? You still have to do it. All right. And then finally, it's already been taxed. So it's not going to have been taxed when you're getting those because the bank's not the one that's going to be doing that. It's taxed to you. So it's not at the entity level. It's going to be taxed at your level. So you're going to have to go ahead and do this. Now, for those of you that have a corporation, there's another area out here, and I have a video out there. It's on the dividends received deduction. So a corporation that receives a dividend from another dividend, you get some kind of deduction for that as well. You can take a look at my video and see how it works based on your ownership. All right. Well, thank you for watching this video. Again, if this has been helping you, please subscribe and be ready for the next videos that are going to be coming out. We're going to be transitioning over to some of the specific 1040s, lines on the 1040, and then we'll jump back to some more schedule and forms to make sure that you're getting everything ready for tax season. All right, good luck on your taxes.